If you are over 72 and collecting Social Security or enrolled in Medicare, there is something happening inside your tax return right now that most retirees never see coming. The IRS does not send a warning letter. Your Medicare plan does not call ahead. It just happens quietly every single year, and by the time most people notice it, they have already lost hundreds or even thousands of dollars they were counting on. The figure that explains this entire problem is 85%. That is the maximum share of your Social Security benefit that the federal government is legally allowed to tax, and for a growing number of retirees over 72, that ceiling is exactly where they end up. I am John, and welcome back to John Retirees. Today, we are covering how IRS rules around retirement income are directly reducing what lands in your pocket from Social Security and what you pay for Medicare in 2026, and more importantly, what moves are available right now to push back against it. Stay through to the end because the last part covers the one mistake that locks retirees into higher costs year after year without them realizing it is preventable. Before we go further, hit subscribe so you catch every update on this channel the moment it goes live. This video is for informational purposes only and is not tax or financial advice. Consult a qualified professional for your specific situation. Now let us get into the numbers. The starting point is something called combined income, and this is the formula the IRS uses to decide how much of your Social Security gets taxed. Combined income is calculated by taking your adjusted gross income, adding any non-taxable interest you received, and then adding half of your total Social Security benefit for the year. The result of that calculation gets measured against two thresholds. If you file as an individual and your combined income lands between $25,000 and $34,000, up to 50% of your Social Security benefit becomes taxable. If your combined income goes above $34,000, up to 85% of your benefit is taxable. For married couples filing jointly, those thresholds are $32,000 to $44,000 for the 50% tier and above $44,000 for the 85% tier. Here's what makes this particularly damaging for retirees over 72. These thresholds were written into the tax code decades ago, and they have never been adjusted for inflation. The dollar amounts that triggered taxation in the 1980s are the same dollar amounts in effect in 2026. What that means in practice is that every year inflation pushes retirement income slightly higher. More and more retirees cross those thresholds without any change in their actual purchasing power. You are not richer, you are just taxed more. Now layer Medicare on top of that, and the picture gets sharper. Most retirees know that Medicare Part B carries a standard monthly premium. For 2026, that standard premium is $185 per month. But what a lot of retirees over 72 do not know is that there is an income-based surcharge sitting on top of that standard amount. It is called IRMA, which stands for Income-Related Monthly Adjustment Amount, and it is determined entirely by your income from 2 years prior. The Medicare program looks at your 2024 tax return to set your 2026 Part B premium. If your modified adjusted gross income in 2024 was above $106,000 as an individual or above $212,000 as a married couple filing jointly, you are already paying more than the standard premium right now. The first IRMA bracket adds $74 per month on top of the standard amount, bringing your Part B premium to $259. Higher brackets go further. At the top bracket, the monthly premium for Part B alone reaches $628.90 per person. For a married couple, both enrolled in Medicare Part B, that is over $1,250 a month just for Part B coverage. In Medicare Part D, the prescription drug coverage carries its own separate IRMA surcharge that stacks on top of the Part B surcharge. And the numbers grow quickly, and most retirees never saw them coming because nobody explained the 2-year look-back rule clearly. This is where the connection between your required minimum distribution and your Medicare costs becomes critical to understand. If you are over 72 and taking RMDs from a traditional IRA or 401k, every dollar of that distribution counts as ordinary income in the year you take it. That income flows directly into your modified, adjusted gross income calculation. A larger than expected RMD in a single year can push your income across an IRMA threshold and increase your Medicare premiums 2 years later. It can simultaneously push more of your Social Security benefit into the taxable range in the same year. And because IRMA uses a cliff structure rather than a gradual increase, crossing a threshold by even $1 triggers the full surcharge for that entire bracket. A retiree with $107,000 in modified adjusted gross income as an individual pays the same IRMA surcharge as someone with $130,000. The dollar just above the line costs exactly as much as the dollar significantly above it. This cliff effect is one of the most overlooked dynamics in retirement income planning, and it is entirely legal to manage around it with the right approach. The tool most relevant to retirees over 72 who are dealing with this is the qualified charitable distribution. If you are 70 and a half or older, you are permitted to transfer money directly from your IRA to a qualifying nonprofit organization. That transfer counts toward your required minimum distribution for the year, but it never shows up in your adjusted gross income. The 2026 limit for this strategy is $108,000 per person. For a retiree who gives to charity anyway and does not need the full RMD amount for living expenses, redirecting part of the distribution through a qualified charitable distribution keeps that amount entirely out of the income calculation that determines Social Security taxation and IRM-A. It does not reduce your RMD obligation. It satisfies part of it while preventing that portion from triggering the downstream costs. The transfer must go directly from your IRA custodian to the organization. If you take the withdrawal first and then donate separately, you lose the tax treatment completely and that income counts in full. Another strategy worth understanding is Roth conversion. Moving money from a traditional IRA into a Roth IRA triggers ordinary income tax in the year of the conversion, which is a real cost. But the long-term effect is that future growth inside the Roth is tax-free, and Roth IRAs do not carry required minimum distributions during the original owner's lifetime. For retirees who are currently below an IRM-A threshold and have room before crossing into the next Social Security taxation tier, a carefully sized Roth conversion in the current year can reduce the size of future RMDs and bring down the combined income figure in later years. The trade-off is paying tax now to avoid larger tax exposure later, and the math on whether that trade works depends entirely on your specific income, account balances, expected future withdrawals, and which tax brackets apply to your situation. This is not a blanket recommendation. It is a tool that works well in certain income windows and poorly in others. The key question to ask is whether your tax rate today is likely lower than your tax rate will be in 5 or 10 years once RMDs are fully in motion. If the answer is yes, conversion deserves a serious look. If your income is already near the top of an IRM-A bracket, converting additional funds this year could push you into the next tier and cost more in Medicare premiums than you save in future taxes. The math has to be run against your actual numbers, not estimated. Before you close out of this video, here is what you need to do. First, calculate your combined income right now using your most recent tax return. Add your adjusted gross income, any non-taxable interest, and half of your annual Social Security benefit. Compare that number against the $34,000 individual and $44,000 joint thresholds to see how much of your benefit is currently in the taxable range. Second, check your current Medicare premium notice and verify whether you are paying an IRM-A surcharge. If you are, trace it back to your 2024 income to understand what drove it. Third, if your 2025 income dropped significantly due to retirement, job loss, divorce, reduction in work hours, or the death of a spouse, you can appeal your 2026 RMA surcharge using IRS Form SSA 44. The Social Security Administration handles this, and a successful appeal can remove the surcharge immediately rather than waiting 2 years for the look-back to catch up. Fourth, if you are taking RMDs and your total income is approaching an IRM-A threshold, look into whether a qualified charitable distribution could keep a portion of your distribution out of your adjusted gross income. Fifth, if you're not yet in the top Social Security taxation tier, but your income is trending upward, run the numbers on whether a partial Roth conversion this year reduces your long-term tax exposure. Sixth, do not assume your tax preparer is watching these thresholds automatically. Ask directly whether your current income level is approaching an ER-MEA boundary or pushing additional Social Security into the taxable range. The pattern behind most of the avoidable losses here is the same across thousands of retirees. It is not that the rules are secret, it is that nobody explained how they connect. RMD income increases combined income. Combined income pushes more Social Security into the taxable range. That same income lifts modified adjusted gross income 2 years later and triggers a higher Medicare premium. Each piece seems manageable on its own. Together, they compound into a significantly higher tax and premium burden that sits quietly in the background year after year, unless someone deliberately looks at the full picture. The retirees who avoid this are not necessarily wealthier or better connected. They simply had someone walk them through how these three systems interact before the damage was already done. That is exactly what this channel exists to do, and it is why understanding the mechanics matters more than any single number. One question before you head out. Have you ever checked whether your Medicare premium includes an IRM-A surcharge? And did you know it was tied to income from 2 years earlier? Drop your answer in the comments. A lot of retirees watching this right now are in the same situation, and your experience genuinely helps others recognize what to look for. If someone you know is over 72 and has not thought through how their retirement withdrawals connect to their Social Security taxes and Medicare costs, pass this along to them directly. A quick phone call or a shared link is worth more than they might realize. The gap between understanding this and not understanding it shows up as real dollars every single month. This has been John Retirees. If you have not subscribed yet, now is the time. Hit that button so you do not miss what is coming next. In the next video, we are going to break down exactly how to read your Medicare premium notice line by line, identify whether you are overpaying, and walk through the full appeal process step by step. Because far too many retirees are paying IRMA surcharges they are legally entitled to remove. You will want that one before your next premium statement arrives. Thanks for watching. And remember, this channel is here every step of the way. Make sure every dollar you earned in retirement is actually working for you.